Well, ladies and gentlemen, my name is Greg Michalowski, and this is a report for September 11th, 2014, talking about the RBNZ interest rate decision, which will take place on that day. Let's get right into it. At the last meeting, what did the RBNZ do? Governor Graham Wheeler announced that they were going to raise their rates by 25 basis points, but he also said at that time that it is prudent that there now be a period of assessment before interest rates adjust further toward a more neutral level. So, the expectations are no change in interest rates. The question comes, does he extend that into this meeting? There's a statement talk about keeping rates unchanged for an extended period of time after this meeting. And since the July 24th meeting, we've seen milk powder average winning price come down by 1.9%. We've seen business confidence move down to a 20-month low. We've seen the 2-year inflation expectations decline to the lowest level since the second quarter of 2013. All of these are suggesting that the RBNZ should be not in a hurry to raise rates any further. Remember, they've been the only central bank that has been raising rates. And so they're kind of ahead of the curve, if you will, rightfully so, but ahead of the rest of the quote-unquote major industrial countries, or major countries, if you will. And the other thing that is going to be interesting in the statement is whether or not he addresses the currency. Over the over the near term, there has been a statement in that says something to this effect. This is what was said last month. With the exchange rate yet to adjust to weakening commodity prices, the level of the New Zealand dollar is unjustified and unsustainable, and there is potential for a significant fall. Well, since that July 24th meeting, I'll go to the daily chart here. This is where we were on that July 24th meeting, up at the 87 level. We've had a fairly significant fall down to the 82.30 and change type level here. So about 400 pips to the downside is where the market has moved from the high down to the low. And so is that significant enough to lighten up on that sentence? That's what the market's going to be paying attention to as well. And it could cause some upheaval by talking a little about keeping rates unchanged for a while, and also talking about taking out the idea about the currency being too high or looking for a significant move to the downside. I don't think he's going to say looking for a significant move to the downside after you move 400 pips to the downside over the last month and a half. So that's going to cause some consternation in the market. The good thing is that we do have some technical levels that we could use to help us determine a bias or to determine our risk, both of those things actually. And the levels that I'm speaking of, if we take a look at the daily chart, include the 50% retracement level. This level comes in at 82.58. Now over the last 2 days, we've traded below it and we remain below it. Yesterday we closed below it. Today we're down below it, and we're likely going to close below it before the 5 o'clock hour. Now if the market should move above that 82.58, that would change the bias a little bit more to the upside. We could see buyers now on dips rather than sellers on expensive. Buyers against this 58 level, and maybe also against the 41 level. I'm going to consider this box right here a big line in the sand, because the 41 level was a low going back to this date in February 20th to be exact. And we had this other low around the 58 level, and that also corresponds with the 50%. Now we've been below it here the last couple of days, but if we move above those levels, look for that to become now support. And that's supported off the hourly chart as well. If I look at the hourly chart and I look at the 41 level right here at 5 o'clock, that's about where this topside trend line is going to be. So if we move above the 41 level, we would expect to see that what was once resistance now becomes support and stay above that level. Here's a 58 level, and that's right around the 38.2% retracement of this move to the downside. So get above the 58 level, stay above the 58 level, and that's more bullish. So overall, I would expect this area right here between the 58 and 41 level to be our line in the sand. We don't want to see, if the price moves above that, we don't want to see it move back below it. If it does, get out of the trade. If it stays above it, that's more bullish. On the downside, if the market should go down, this becomes our resistance level and a stronger level on the upside. We won't expect that price to move back above that level. On the downside at 5 o'clock, we're going to be looking for the 81.90 level. That's the bottom side of this channel that we're in. And if we move below the 81.90 level, it opens up the door for downside. Then this support level becomes resistance, and we'd expect to see the market to stay below that 81.90 level. So on the top side, we have the 58 level. Get above it, stay above it. That's bullish. On the downside, get below let's say the low right here, and then get below the 81.90 level, then the bias remains to the downside. Now, if the market does move higher, another key level to consider here is the 82.77 level. That's where the 100-hour moving average is, and the 50% of this move. The other key level to consider is this level up here, the 200-hour moving average. Why? The last time we tested that 200-hour moving average right here and right here, the market held that level and stayed below it. So the market remembers those things, folks, and so look for sellers up here against the 200-hour moving average on a first test. If it moves above that level, we're going higher, okay? We should be going higher, and we should stay above that level. That's it. My name is Greg Michalowski. If you like this video and want to see more of them, make sure that you visit our website or you like it on Forex Live right here, subscribe, and also visit our website daily at forexlive.com. Bye-bye. Good fortune with your trading. Be careful. Bye-bye.